Of the four stock market indices that we cover here, U.S. indices, I think the Dow is giving us the cleanest structures and Fibonacci targets. So on the Dow, I use the DTN data feed, and I started the data in November of 1965, and I did troughs only, no repins. And I'm going to bring that up over here in the other monitor. Go back to the quarterly chart. And still waiting for Cineant Trader to load up here. And it'll bring in the data and start figuring it out, and we'll look at that after it's finished. And so nothing has changed on the long-term wave count whatsoever. I think that up from the 2009 low, actually up from the 1932 low in the Dow, we have a 1, 2, 3, 4, and extremely extended fifth wave underway and nearly complete, but not complete yet. The best Fibonacci target at this juncture for the end of teal or cycle degree wave 5 up from the 1974 low would be 41,020, and that, if it stopped going up at that price at that level, then the 1974 low would cut the entire distance from the 1932 low to that high by the golden section. In other words, you take this distance from the beginning of the pattern to the end of wave 4, take that on a Similog chart times 1.618, and that creates an extended fifth wave target. Next target, it would be within the fifth wave up from the 1974 low, 1 in burgundy or primary degree, 2, 3, 4. This would be a fifth wave up that we're in right now. It needs to subdivide as 5 complete waves. And the best target that I always use for a fifth wave initially, unless it becomes extended, would be where wave 5, in this case burgundy, would be equal to the net traveled of 1 through 3 burgundy times 0.618. And that's at 41,981. I got that line there. And then up from the 2009 low, looking for a burgundy, this burgundy fifth wave to subdivide into 5 intermediate degree or black waves to upside. 1, 2, 1, 2, 3, 4, 3, 4, and this needs to subdivide into 5 waves up here. And the best target, using the same system as I used here for the end of black wave 5, would be equal to the net traveled of 1 through 3 times 0.618 on the Similog chart, and that's up at 43,652. So I've got a cluster of targets up there on the Dow. None of those have been hit yet. As we move in closer, so I'm looking for this to be a black wave 5, and it needs to subdivide into 5 blue or minor degree waves. As I've explained many times in the webinar, I believe that the rocket ship move up from the March of 2020 low was in fact a zigzag. It traveled about 80% of the way to my target zone, but because it only subdivided into 3 waves, I'm calling that wave 1 of an eventual contracting ending diagonal, and I believe we are in the wave 2 of that diagonal right now. Whereas the wave 1 was a simple zigzag, we're looking at something a bit more complex for the wave 2. Why do I think this subdivides into only 3 waves up from the March of 2020 low? Here's the count. 1, 2, 3, 4, 5 for A. Very quick B wave, and then 1, 2, 3, 4, and then an ending expanding diagonal for 5. And wave C in pink ended up coming very, very close to equality with wave A in pink. That's a very typical uh, relationship of A and C in a zigzag. I do not believe this counts as a completed 5-wave structure to the upside, and therefore I don't think that is as high as the stock market will ever go. I think that's coming over here, and it'll be up inside of this target zone, which hasn't been hit yet. And then ever since January of 2022, I think that the correction for wave 2 of this ending contracting diagonal is unfolding in a more complex manner. A, B, C for a W, A, B, C for X. And as the market was putting in that top in late July, early August of this year, I was saying that it was most likely at the high for the year of 2023. And we'll take a real hard look at this downward movement so far here on the daily chart here in just a second. As a reminder, each leg of a diagonal is typically deeply retraced. In the blue book, it says that wave 2 of a contracting diagonal should retrace wave 1 between 66 and 81%. That's this target zone down here. But the way it's unfolding so far, we can also use some additional Fibonacci tools. And so if I measure from this high in January of 2022 down to the low in October of 2022, and I consider that a unit of 1 and take that times 0.618 and add that amount to the bottom of that, then there's a target of 24,495, and that is where wave, in this case, Y in pink, would equal a 0.618 expansion of wave W. So as I've been saying for months and months and months on end, no change to the story. We're likely moving down into approximately the middle of next year, and we'll have a very sharp, quick recession. It was very interesting this week to see the GDP came out at 4.9%. 4.9%, that was the GDP for the third quarter. So that ended at the end of September. I'm not really convinced that that is a very accurate number, but we have to take those government announcements as they come. There certainly is some weakening showing already in the economy, but apparently it didn't show in the third quarter, according to the government. Very interesting. And so that's not exactly, the GDP that you would expect just prior to a recession. So something for if we are going to get a recession here, and the official definition of a recession is 2 consecutive quarters of negative GDP, then we would need a negative GDP for the fourth quarter and the first quarter. And so they wouldn't be able to, if that did happen, they wouldn't be able to say that we were in a recession until approximately the end of April next year. And you can see that I'm expecting this leg down to end, according on the most current Hurst is suggesting late May. In my experience as a businessman during my entire career, I have noticed many times that by the time they say there's a recession, there are signs that the recession is just about over. It's a severely lagging statistic, and so it'll be interesting. It's possible they'll be able to get through this thing without two negative quarters, and they can the Fed and can claim, and politicians can claim that we didn't have a recession, and even if the um, even if we get this in relatively enormous puke down into approximately the middle of next year. One other thing that I always point out on this chart is in October of 2022 was the first time that we got the inversion of the 3-month and 10-year bonds, where the 3-month bonds were paying a higher rate of return than the 10-year. Very rare condition. And this is something that is often in history very reliably followed by a recession with approximately, roughly, a 6-month to 18-month lag. So whether or not this is called a recession down here or not, I don't know. I guess I'll take that word off of there. But not expecting the end of this wave 2 correction down in until approximately mid-year next year. Notice I've done some manual phasing on this. So starting from this March of 2020 low, and what I've done is I've made these 18-month cycles rather equal, and the last one ending at the bottom day in October of last year. So using that system, if this 18-month cycle, Hurst cycle, was the same length as the average of the last two. As a matter of fact, I think you can go back and say it's the average of the last three. Then this move to the downside might only take us down into January. However, when you look at the price action that has happened since October, this dip right here would be too early for a 20-week cycle, for a 40-week cycle. So the 40-week cycle was probably over here somewhere. And that was a long 40-week cycle, very likely. There's no really good place to put it. And if that was the 40-week cycle, where I've got it marked here in early October, then the next 40-week cycle would take us, because there's two 40-week cycles and an 18-month, it would take us probably to that May. And that's the reason why Hurst is saying late May and not early January. We'll get a look at that again here on the daily chart. But on the daily chart, I'm showing some manual phasing. So in other words, I'm not trusting the Hurst or Cynthia Trader system implicitly. I'm looking at some, and each of these pink cycles will be an 80-day, and then two 80-day cycles makes for a 20-week, and that would be the blue. So we had a 20-week cycle here, and then an 80-day, and then probably a 40-week cycle here. Okay. So that would be the midpoint of if this was the 40-week cycle, which, by the way, Hurst was, Cindy and Trader was sure that it was a week ago, but now it's not sure. And I'll show you that in a second. But so the second half of this 18-month cycle if that's the midpoint, the 40-week cycle, we would have 1, 2, 3, 4 more pink cycles from there. So 1, 2, 3, 4. So that puts the projected end of this 18-month cycle we're in, using my manual phasing in late June. So the way 40-week cycles work is you've got the first 40-week cycle, which was bullish, and then you have the second 40-week cycle, which would be bearish. And within that 40-week cycle, the peak, okay, so this would be a cycle that runs from here, this 40-week cycle, to here. I'll draw another cycle on the chart so you can kind of see that. We're going to change the color on that to something else like black. So you would expect the peak in the middle of that bearish cycle to occur as a left translated peak. So there's the center point of the cycle. So Hurst would expect a significant peak to occur prior to the midpoint in that cycle. So that's exactly what I think is going to happen is we're going to have the high point within this next 40-week cycle to occur left translated. So that would be prior to the midpoint of the cycle is approximately late January. So prior to that. So here is the Hurst cycle analysis on the Dow Jones Industrial Average. You'll notice that it was expecting a 40-week cycle trough somewhere in this neighborhood here. Now, it could have been here, would have been a little late, or it could have been here. But so Hurst has decided it doesn't know for sure where that 40-week cycle trough was, but it still is able to go about its business based on what's happening with the smaller cycles, as well as the larger cycle. So, and you'll notice that the composite line is bullish from approximately now. Here's this tidy nest, an 80-day cycle trough nest centered on October 27, and it's projecting upward movement through 12/24, December 24. And then it gets going to the downside in what looks like on this chart is 5 waves. 1, 2, 3, maybe a triangle for 4, 5. And that would be down through approximately late May, early June. Late May, early June. This is currently saying maybe June 1. So, and I'll show you a few more Hursts as we move down, as we move through the webinar, and that message is still rather that message is still rather universal that we're going to get a bounce next through late in the year. So this is what I'm saying, and so a lot of people getting real excited about how aggressive this move is to the downside. So let's look at this move to the downside and see what we think is going on. So I've got this peak on August 1 on the Dow labeled as a pink X. So I'm expecting an A in green, a B in green, and a C in green on down. This looks now like a 5-wave structure to the downside, but there's some problems with calling it a 5-wave structure, just simply calling it a 5. One is that this low right here was overlapped by this rise through mid-October that we saw. So we got an overlap. That's a problem. Also, if this were a 1, 2, 3, 4, 5, this wave 2 here looks like a triangle, and you cannot have a triangle alone in a wave 2 position. So I've never been counting it as that because of those two reasons. As a matter of fact, I think that what we had, this triangle clues us in that was likely a wave 4. So 1, 2, 3, 4, 5 for wave A in green. And now after 3 waves up, we would expect an expanded flat. 3 waves up for wave A, 3 waves down for wave B, and then a 5 wave up structure for this move up. Yeah, Dennis, it could be if 1-2-1-2, and I'll acknowledge that that's the 1-2-1-2 possibility is um, still in. It's a little more likely in something other than the Dow. As we'll look at that on the S&P, but we are moving into a period of seasonality here in the fourth quarter. The DSI, the daily sentiment retail traders, have hit a 10 on Friday on the ES contract, extremely low number. So we have sentiment supporting a short-term bounce. We have seasonality suggesting a short-term bounce. And this looks like 3 waves up for an A and 3 waves down for a B to exactly hitting that theoretical max. And also, there's 2 targets down here. Wave C would be a 0.382 expansion of A. So that in a zigzag, that is a real common target for the end of purple, wave C right here. So I've got 2 Fibonacci's right there. The question is, what would be the invalidation on my count? Well, substantial further downward movement would be a problem for the count. And then I would have to tell you, uh, if it does continue lower, what would the count be? And I guess 1, 2, 3, 4, 5 for 1, and then 2 very short duration wave 2, and this would be wave 3. And in which case, this would be a 1 and a 2 and a 3. So we'd have to see aggressive downward wave 3 character to the downside in order to change this count and basically put that green B right here. So Hurst would have to be dead wrong. And so that's what it would take. It would take aggressive downward movement from there. So if I'm going to take this out of Simula, and I'm going to look for a target for the end of wave 3. So this would have to, let's see, if this was a green B here, this would be a purple 1, purple 2, purple 3 target, 31, 315, and that would be nowhere near as low as it would go. And then we'd have a 4 and a 5. So 1, 2, 3, 4, 5. And that would complete an ABC zigzag through that. And here's the problem with that. That wouldn't be anywhere close to low enough. That wouldn't be anywhere close to low enough. So I don't, what I'm expecting is a massive move to the downside to below the October low, not just an ABC here, or I guess that could be a 1, 2, 3, 4, 5 for an A further down. Anyway, yeah, we're in a tight window here as far as and I needed an alternate anyway. I'll put that B right there. But as you can see, uh, Hurst isn't suggesting that. Sentiment is not suggesting it. Um, and um, seasonality is not suggesting it either. So I like this count. I like the subdivisions in this count. Everything works, and we're at a critical juncture on the count right now. I've rarely seen the market puke out, hit a 10 this high up when I was expecting that much more to the downside. For it to hit a 10 DSI here would be, I would say, highly, highly unusual. So, yeah, I'm expecting this bounce still. And this is all, so I haven't changed my mind at all on my main count as far as what I've been saying, which is that I think the market will manage to, quote unquote, stay up through late in the year. Notice it's projecting up through December 23, 24 timeframes. I've also been suggesting that that was going to probably this bullish seasonality probably would carry this index higher through approximately year end. So there's the Dow. Um, let's see if there's any other clues we can find on the Dow that it's potentially at a significant low. Well, there's this one, excuse me, on the algo, where the money flow is still riding above the RSI. The RSI is oversold, but the money flow is above it. This throws up a dark green stripe. When's the last time we saw a dark green stripe? Heck, we didn't even see one. Yeah, here we go. It was in late September of 2022. And that pretty much marked a bottoming area that was followed by some pretty solid upward movement. That's the last time we saw one of these little dark green stripes. And I think what that dark green stripe indicates is that money managers are, I think, counting. They're not heavily selling here, I don't think, because they are looking for a um, traditional bullish seasonality toward the end of the year, and a lot of times the money managers are behind the indices for the year and want to do some catching up in the traditional bullish period during the fourth quarter. And I think that's what that is, the message that is sending. Also, on the Dow Jones Industrial Average, commercials are all still heavily long, and that's what I was basically just saying. And it very well could be based on sentiment that the buying that we see in the fourth quarter will be an old line safe haven stocks. In other words, the Dow Jones Industrial Average. You can see retail way down, oversold. commercials heavily long. So this, the Dow Jones Industrial Average, I think, is at a critical juncture where it could get a snapback sort of rally on through year end. Am I expecting a new, high for the year? No. I'm just looking for a return to the wave four of one lesser degree. So in other words, I'm expecting a three wave A, three wave B, and a five wave C back to the wave four of one lesser degree. That would be at 34,776. Then the, pretty awful first couple quarters of next year. If all of that happens exactly to my targets, that late into December, there's potential drop of 30% from whatever peak we would see late in this year down to my target, 30% move in the Dow. The last time we had anything close to that was, of course, the COVID plunge, where we in 5 or 6 weeks had a 38%. I'm not expecting this to occur in 5 or 6 weeks. I'm thinking it will occur over 5 to 6 months.